Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So today we have Steve Haskell with us, and Steve came through the military world to commercial real estate. So Steve, it's great to have you. If you can give us a little clue as to how you got into commercial real estate from the San Diego world, that would be great.
Yeah, you bet. Thanks, Bruce. Appreciate it. I spent a little over 7 years active duty in the military. I'm an officer. I'm an officer in the reserves now. But I really had a great time. Was all over the world, deploying all over the place. I was in the special operations community. It felt like a movie, but it wasn't all that great for my family. So that they didn't get to see me very much, and I had one little boy, basically missed his first year of life. So
Mm.
my wife, she said, "Hey, I promised you 4 years. You got over seven, going out and getting bad guys and having fun. So now it's time to settle down." And I said, "Yeah, that's a good idea." So I had a friend that was starting a business out in Southern California, and basically it had to do with in taking investors and putting money into syndicated real estate. So large properties, big multifamily buildings, industrial buildings, self-storage, you name it, usually anywhere from 50 to 100, $150 million properties. And then our clients would buy pieces of those properties. And it was just a little business, had a couple of guys working for them. So I came on and helped them grow. I think we had about 50 when I left,
Wow.
raising about 600 million a year, I think was our top year. And then I stepped away and took over capital raising for a company called Realty Mogul, doing similar type of business, more crowdfunding, larger audience, even international capital raising. And then they got the VC board that ran that company. They decided to sell,
Oh,
and then a lot of leadership they were let go, and so I took some of the team from Realty Mogul, and we started Anchor 1031. So now we're doing a similar type business, helping people do 1031 exchanges into syndicated passive real estate. And we get to do it our way now for the first time. We get to treat clients the way we want. We get to sell and advise how we want to sell and advise. And it's been exciting.
that does sound, and you've been at that for about a year now, right?
Yep. Yeah. I've been in capital raising for almost a decade of doing this type of business. I've been a part of about over 1 billion in capital raised. And my partners are a similar amount. But I think we're about 7 months into it now on our own business, and we're doing well. I think we're on track for a little over 20 million in our first year.
So I'm curious, do you find the property and then find the people to buy the property, or is it reverse, or sort of one each side goes at the same time?
Good question. So we mostly focus on the Delaware Statutory Trust. That's our investment vehicle, DSTs. And so there's large sponsors that put together these deals. Big sponsors you might have heard of, like Cantor Fitzgerald or Blue Rock or JLL or Hines. These big giant companies usually have multi-billion dollar REITs. Anyways, what they do is they buy one of these assets. Say it's a 350 unit multifamily building in Raleigh, North Carolina, and it could be $150 million. They buy it on their own balance sheet and put it in this trust. Then they come to our firm and they say, "Hey, Steve, will you guys sell this property to your investors?" So our due diligence team, we use a broker dealer, they go through and they underwrite the property, they look through the structure, they look through the third party reports, they look through the environmental reports, engineering, the appraisals, they go through all that, the deal structure. And then if it passes due diligence, then it gets put on our platform. And then we review the properties, and it's one of many different opportunities that we present to our clients. And then we like to typically diversify our clients. So we won't just sell one deal. We'll put pieces of their investment in various different properties.
What's the typical investment for the people that are putting money into a DST through you?
I think the average is typically somewhere between 300 and little under $1 million. But it can be as small as 100,000 typically is the minimums. We just wrapped up an exchange that was around 7 million last week, and I've done exchanges that were in chunks that went up to about 100 million in the past.
And what sort of return are they getting on their DSTs?
Well, so for cash on cash,
Mm,
just the income that they receive on a monthly basis, it could potentially be anywhere between 4% to over a little over 6% cash on cash, potentially. And then whatever potential appreciation happens when they sell, the investor gets their pro rata share of whatever appreciation potentially takes place on the back end.
well, typically with the DST, you have to stay in for the full term of the purchase and then the sale of the property, right?
Right. So typically that's going to average around 5 or 7 years.
Mhm.
There's a lot of DSTs right now that are actually doing something called a 721 uprate. But basically what that means is that DST will go up into a REIT in
Oh,
around 2 or 3 years.
oh,
So that's another exit strategy that has its pros and cons, just another opportunity. They can sell early to another investor, but
right.
they're not very liquid. You have to be an accredited investor, meaning having a net worth of at least $1 million or making at least $200,000 a year as an individual or $300,000 as a couple. Those rules are changing a little bit potentially, but that's the general rule. So I tell my clients, don't make a decision or don't make a contingency plan of getting out early, but there's nothing legally saying you can't sell to another investor before the property eventually sells off.
But that doesn't happen very often, I assume.
No, I've only done a handful of those secondary transactions where people needed to get out early.
Yeah, and so something happens and they need their money back and off you go. I suspect they end up selling it a little bit of a discount of over what they might get eventually.
Yeah, I've done both. Some properties were outperforming and they were coming close to their exit, so it could be a little more of a premium there. But mostly you're gonna expect taking a bit of a discount.
Yeah, yeah. But again, and that does most people are in it for the term and they just want to place their money and get a decent return and off they go from there.
Yeah, and some investors they don't even like the fact that it's gonna sell someday. So that's why they really want to go passive. So that's why they go up into the REITs and they just say, you know what,
Oh,
I just want to be done with it. I want to live off the dividends. My kids will get it someday. So I want to go for a 721 up REIT strategy, meaning their property, if they stay in the DST, they can 1031 out eventually. But when it goes up into the REIT, you can't. You're married to the REIT now.
well, isn't the REIT then publicly traded? Can't you just sell your stock?
Yeah, some are publicly traded, others are privately traded with
Ah,
different levels of liquidity. So some
oh, I
have
see.
quarterly liquidity features, for example. And then, of course, as you know, a publicly traded REIT, you can sell it with a click of a button.
Right, right. So it just depends on what type of REIT they're in or move into. So the 721 can move them from the DST into the REIT and off they go from there.
Right.
Yeah. But it sounds like for the most part, most of your investors are just looking for the kind of slow and steady wins the race approach.
Right. Capital preservation with modest income, potential income, and appreciation on the back end. We're not hitting home runs. I mean,
Right,
there have
right,
been, but that's not our goal.
right. So there have been cases where things turn out very well.
Right. Things coming out of COVID and so forth. And, in the 2000s, coming out of 2010 time frame, like there were some really good runs in the market. But I don't expect anything like that in today's market.
It's it's a steady market right now. So
Right.
what's your, well, which leads us to what's your crystal ball looking like these days?
Well, a lot of the quality institutional multifamily, it's not spitting off those seven caps like we saw back in the day when a lot of our retiring landlords, bought their properties. But what we are seeing is being able to buy at a great value where the replacement cost is sometimes anywhere 20% or more um, higher than what they're buying in at.
Right.
So there's no guarantees, but it's a pretty good indicator that you're going to get some predictable growth. If you build the same property on the same location, it's going to cost you 20% more than you're buying that property at that time. It's a good indicator that your money is relatively secure. Anything can happen, but based on the numbers, we're seeing institutions dive back into the market for multifamily now because I mean they're potentially seeing 10 to 12 IRRs, I think, even to 15. I think I heard a CBRE podcast that they're talking about that they're shooting for. So they're much comfortable with that type of risk to return profile than going into a more high risk value add venture that's only getting them a 17 or 18%
Huh.
IRR. So it's
Wow.
we're finding that those class A multifamilies are becoming very popular and providing some potentially predictable returns.
So I assume the 20% replacement cost above the or below the 20% replacement cost is driven by construction costs.
Yeah.
Yeah.
Yeah, it used to be interest rates, but we're starting to see interest rates come down a little bit. But the inflation in materials, labor costs, and interest rates really drove up that replacement cost, and that's why we've seen new construction permits just being at an all-time low, basically in the recent history.
Yeah. It's kind of sad, unfortunately, but well, supply and demand and all those things fold into it.
Right.
So, uh, well, it's interesting. So, how are you marketing yourself?
You know, AI has really done a
Here we
lot
go.
for reducing barriers to entry, to tell you the truth.
Okay, that's
Um,
so. How are you using AI? That's intriguing.
Yeah, so basically, we use AI, different bots. We got guys on our team that have become experts in it. They really scrape the internet to find out what people are looking for and
Mm,
the type of questions that they're asking. And so then we put together different formulas and agents that can generate quality answers to those questions. And then we publish them in a way that's discoverable.
mm,
And so it's the SEO isn't working the same as it has in the past. I mean, you're always going to have the big guys that are paying for ads on Google that show up at the top,
right,
but the way that AI search with learning language models and things like that are taking place, it's allowing smaller guys to write higher quality content
right.
and be discoverable online. So, which is great for us because what we've been able to do is provide a very impressive platform with market reach, and we're able to get awareness out there for a shoestring budget, which
Hmm.
gives us survivability. So
Wow.
we can live off of a lot less than our competitors that have payrolls and huge marketing budgets, and we can survive downtimes. And because we can write a lot of AI models to review private placement memorandums and review due diligence items quickly, show us the risk and highlight a lot of the risk points, so we're not searching through hundreds of pages of documents by hand. We can spend more time with our clients, so we can
Wow.
provide a higher value of service.
Well, so that's interesting. So you basically are saying that, hey, AI is reliable in terms of looking at the due diligence and the reports you get back from AI are credible enough that you really feel strongly about them being trustworthy.
Yeah, I mean, this comes through a lot of trial and error, but what we like about most of the models that we use is they give us a link. So on those critical items where we say, hey, this looks strange, we can just click the link. It'll take us to the page in the due diligence document that we searched, and we
Wow.
can read it for ourselves. So we're not just taking the AI output and taking it for face value. We're actually, if something looks odd, we'll go back and double check it, and especially if it's an item of consequence.
Right, right, right. So hey, how often does that end up sort of kicking a property out of your cohort, so to speak?
Well, we don't actually use it for well, we don't at Anchor don't use it for actual due diligence. We have a team that looks through all that by hand and analyzes all that information. What
Right.
our team uses it for is to scan it and communicate information to our investors. So
Oh, okay.
our number one thing is we want to be able to understand 50 to 100 different deals
Yeah,
quickly.
right.
And so we spend a lot of time up front with our clients learning their criteria, learning their goals and objectives. We have to go out and find properties that match those goals, objectives, and risk tolerance. So we'll go back, find those, run it through, run those private placement memorandums and due diligence through our models. It'll help us identify certain items that we then communicate to the investor and say, hey, just want you to know here are some items that we found out deep buried in this private placement memorandum that you might have missed otherwise, you know. So,
Wow.
and
Oh, that's
then we can help build a portfolio that at least they're going into with the information to make the best decision for them and their families, right? So,
yeah. Well, so I'm curious. I mean, obviously there's the upside. Yeah, I suspect that there have been cases where you went, oh, darn, that was not a good investment. We shouldn't have gone there, or we shouldn't have led our investors on that side.
you know, that's happened to me in the past before for sure. But at Anchor, we don't do high volume of clients. We hyper focus on single clients, so we have time. So we
Yeah,
spend time going through all the DSTs and all the ticks and whatnot to make sure we're finding all that information that we're going to the client will make a decision on. And
yeah,
so we really don't have as much opportunity due to the way that we do our advising that lends to those types of mistakes. Not saying they won't happen, you know, because you
yeah.
do this
Right.
long enough, there's things that
I'm
can
I'm
miss.
not
But
sure it's really a mistake. The market can change and things go south, whatever, something happens. But anyway, it's real estate. There are cycles up and down, and hopefully you hit the up cycle
yeah,
and you hit it with the right location, and off you go from there. Well,
right.
this sounds like a fantastic platform. I hope people are very interested in jumping into it because I think there are a lot of people out there looking for places to place their money, and they don't want to necessarily just buy a straight 1031, triple net deal, and they want to find something that's a little more solid.
Right. The nice thing about what we do is it's completely passive. All the information and the due diligence is available for review. And it's already bought and stabilized. So there's no closing risk. It's already cash flowing. It's real estate. So the same risks that are in any real estate are in our investment opportunities as well. But heck, a triple net, you don't have to negotiate with the tenant to renew the lease. You're not going to get in. I've had people that had to deal with bankruptcies and buildings going dark, the tenants
Yeah.
just deciding not to pay, even with big credit tenants.
Oh
They'll
yeah, no, it just things happen and you just never know. You
right.
end up with a J.C. Penney's that's empty or whatever. So
Yeah.
it happens out there.
Yeah.
This is very exciting. I think we should get some people to call you off of this podcast. I'm looking forward to talking to you down the road here. So, Steve, where can people find you?
Thanks, Bruce. Yeah, check us out at anchor1031.com. Anchor like on a boat, then 1031, which is 1031.com. And my email is steve at anchor1031.com.
Fantastic. All right. Well, let's keep in touch. I think we need to talk down the road here again very soon.
Yeah, I would love to, Bruce. Thanks for having me.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.